This past weekend was the annual Berkshire Hathaway shareholders extravaganza where Warren Buffett was asked many questions, not surprisingly, on inflation. What is he seeing? Let's go through some exact quotes where he says, we're seeing very substantial inflation. He called out how the economy is running in super high gear. We're raising prices and people are raising prices to us. The definition of inflation. The economy is red hot. Again, it's almost a buying frenzy. That's a direct quote. And he goes, there's quite a bit more inflation going on than people would have anticipated 6 months ago. So that's a change in perspective in terms of what's going on. And maybe not surprising that we've seen some high flying growth stocks also take a little bit of hit during the same time period. We'll talk about that in a second. Now, keep in mind, these comments need to be taken in context, as Berkshire Hathaway is not just, a cross section of the economy. They have very specific markets, very specific companies that operate in certain markets that have more inflation than others. For example, like prefabricated homes, where they're very sensitive to, let's say, steel prices and wood prices. So where you're seeing a buying frenzy in wood prices, and wood prices of timber has just gone bananas. You are going to see inflation where you're raising prices and people are raising prices to you. So seeing very substantial inflation definitely makes a lot of sense. Now, given this context of higher inflation, what does it mean for you? What does it mean for your investments? Are your investments at risk? What should you think about it? And hopefully, this is where my personal experience working on across Wall Street in a variety of jobs, whether or not it's investment banking, studying distressed debt as a research analyst, as well as buying and selling stocks for a multi-billion dollar hedge fund, could be helpful for you. And just for the viewers tuning in for the first time, my name is Daniel. This is Unrivaled Investing. This is a no hype, mission focused channel where I'm usually trying to find multi-baggers, types of companies that I think can potentially go up hundreds or thousands of percent. So usually that's what I'm calling out. But sometimes there's a macro headline or an interesting story that I just want to dive into, and that's the case of this video. But going back, so what does inflation mean for your portfolio? Are your investments at greater risk? Now that Warren Buffett, who, he's a straight shooter, he's calling it as he sees it, he's saying there's inflation. What does that mean for you? So usually, to understand what does inflation mean for your, let's say, stocks, is usually it translates into higher interest rates when you have higher inflation. Why would you have higher interest rates? The reason why is because investors around the world say, well, wait a second, why would I want to hold dollars if it's depreciating at whatever that rate of inflation is per year? So you're losing buying power at the rate of inflation. So if it's 5%, then I need to get 5% in interest rates at least to make up for it. And so then you start creating this opportunity, or it creates effectively an opportunity cost for your cash. Currently, people are like, well, wait a second, I'm not getting anything on my cash, or I'm getting very little. And that's because interest rates are still very low, and interest rates really haven't started catching up to the inflation that, let's say, Warren Buffett is seeing. Now, what does that mean for your investment portfolio if you start seeing rates go higher to match the inflation that Warren Buffett's seeing? So, one is cash. Cash loses whatever that inflation is each year. And that's the reason why folks like Ray Dalio say things like cash is trash, is that long term, over a multi-year period, cash is probably the worst asset to hold over a multi-decade period. So you don't want to be just sitting in cash, putting it under the mattress and hoping for the best. That is going to lead to a sour outcome. The next is bonds. Bonds generally get ripped unless they're inflation protected bonds, which is a whole separate type of vehicle. But fixed rate bonds, if inflation goes higher and then interest rates go higher, then those bonds usually take a haircut as well. And so for all those, fixed income investors, those major pension funds out there that are required to hold 30, 40%, bond portfolio as well as a stock portfolio, this is going to be tough for them to deal with, potentially facing higher interest rates in the future. Okay, so then the next component is what's the impact on stocks? You already know what inflation can do with commodities. With certain commodity players, it's a win. You see timber prices. The raw commodities can be great plays in highly inflationary environments. That said, you're ultimately buying a commodity, and is that really how you generate a lot of wealth over a multi-decade period? Over a multi-decade period, commodities really aren't the way. They will pick up in inflationary periods, however. So that leaves stocks. Okay, so what happens with stocks with higher interest rates. And here's where it's saying, well, wait a second, what's the opportunity cost? If I were to own, let's say if you can get cash, or let's say short duration bonds, treasury bonds, so backed by the full credit of the United States, is, let's say, 5%. And then, you can get 5%, which is this risk-free rate, because, no matter what, the U.S. government, even if they can't effectively finance it, they'll just print that money, and you'll be getting that money back at 5% a year. Is that attractive? And so then you have to consider, well, what's my opportunity cost? What else is available? And so if you have, let's say, a low to no growth stock with limited future growth prospects, and there are plenty out there, trading at, let's say, a 20 times earnings multiple. The way to think about earnings multiple is you invert it. So whatever that is, 20 times earning multiple is the equivalent of a 5% yield. So now you're starting to compare stocks, and you're saying, wait a second, I can get 5% risk-free, or get a stock, let's say, at 20 times that might not grow that much in the future, and it has all these inherent business risks. And so when that happens, you start saying, well, wait a second, if these companies don't have great growth prospects, I'm going to want to get a big discount in terms of that PE multiple. So the PE multiple starts taking a hit. So really this means as rates go up, valuations start to come down. You start having to play this dance of like, well, how much cash am I going to get as a shareholder this year? Because I could be getting 5% elsewhere. I could be getting 5% risk-free from the government. That hasn't happened yet, but I'm saying, what happens if rates start going up? So the valuation comes down as investors say, wait a second, I can be getting money now risk-free versus hypothetical gains in the future. And so you'd start saying, well, wait a second, stocks really haven't actually started coming under pressure yet. And I'd say, well, hold on a second. That actually depends on what stocks you're looking at, because a lot of it depends on which sector in the stock market. Yes, the S&P 500 is still near highs, but that's because a subset of the S&P 500, interest-sensitive subset of the S&P 500, has actually benefited, such as banks. Banks have a business model where they make money based on interest spreads, so they're able to loan money out. If interest rates go up, hey, we can make a greater spread and the banks can do better. So banks have done well. So have insurance companies. But other high-flying growth stocks where they won't be profitable potentially for years, and the prospects of a dividend in any given year might be decades out, those stocks are getting hammered. And it's not surprising to see the hyper-growth type portfolio of maybe story stocks, let's say owned by like an ARK ETF, that is still well below their highs from earlier this year, as investors are starting to say, well, wait a second, if inflation risk is legitimate, could this hurt these growth stocks, these unprofitable high valuation growth stocks? And so you have this dynamic of higher prospective interest rates definitely does impact certain stocks more and certain stocks less. In some cases, it's good for the stocks, and if you're a commodity related stock, it might be great. If you're an oil producer, this or you're a timber producer, you would have ripped higher. Okay, so have actually interest rates moved so far? Have they responded to the inflation that Warren Buffett is seeing? And honestly, not that much. You're still looking out at very low, close to historically low interest rates. You're talking about very low single digits, 1%, 2%, 3% type interest rates on the Treasury securities of the United States. Now, this raises the trillion-dollar question that you have with the inflation currently, which is this inflation transitory, meaning it's just going to pick up and then die out, or is this actually setting things in motion where you could potentially have inflation go on for years? And that is a very tricky question, because so far what the bond market is saying with low rates is they're saying, yeah, we're pretty sure that this is transitory. You might have a short-term spike, and maybe some of it's due to supply chain issues. There were some industries that were shut down in response to COVID, resulting in shortages. Shortages inherently mean inflation, because you still have that same demand, but if you have a shortage of supply, price goes way up. And so that's, for one perfect example is computer chips. where there's a huge chip shortage resulting in pricing just going bananas. Same thing, similar problems with timber. And so some folks are thinking, well, wait a second, this is transitory within some time period, maybe it's 6 months, maybe it's a year or two, that this inflation, it's going to settle back down to the close to no inflation that the Federal Reserve has been talking about for years. The Federal Reserve also seems to think that it's transitory in nature, and they've said, look, they have a dual mandate of employment and keeping interest rates, keeping inflation low, keeping it below this 2%. And their view is, look, it might temporarily go above that 2%, but we're not going to do anything about it because it's transitory. It'll come back in the future. So I would say you have to look at the bond market and see what it's saying. So far, it's saying no big deal. It's going to pass. There will be a few months that'll be concerning. You'll see higher inflation figures, but per Jerome Powell, the head of Federal Reserve, per the Treasury bond market, it's not that much of a big deal. So, the question is there a way for you to make money off of this? And this is once again worthwhile to tune into what Warren Buffett has to say, or a direct quote where he goes, "We do not think we can make money making macroeconomic predictions." And that's his history, focused on exceptional companies that he thinks have a strong competitive advantage. I prefer to use the word unrivaled, because if you're unrivaled, it means you offer a good or a service that other companies simply can't compete with. And then if you do, and you truly are unrivaled, you can win over time and grow over time. And so, it's a similar focus. So what's my take? What are you supposed to do from here, recognizing that inflation might be picking up in the short term? Not sure. $1 trillion question if it's actually transitory. Is the Treasury market just late showing up? Or, where in a few months from now, Treasuries will be much higher? Or is it a big nothing burger? And so my take is that higher inflation does create a few risks that can potentially derail your investment portfolio. So it elevates the risk that there's sort of a big risk-off event that just completely sideswipes your investments. So why? Number one is that the market has been buoyed by the Federal Reserve stimulus this past year. Each month, hundreds of billions of dollars in securities that they're buying, typically Treasury bonds, that effectively goes back to the bond market, goes back to shareholders, and sort of this there is no other alternative in people buying stocks. If inflation does go well above that 2% mandate, the Fed put, where they'll do whatever it takes to bid up the economy, stocks, that Fed put might be off the table, because you're effectively starting to play a game of chicken, where Jerome Powell's saying, yeah, it's transitory. If, let's say, by their own metrics, which a lot of people think are actually, artificially low, if by their own metrics, let's say inflation starts running at 5-6%, and they're saying, look, our mandate's 2%, for how many months can they stick at that and sort of stay, straight face and be like, yes, it's transitory? How many months until they crack and they're like, you know what, we can no longer do what we're doing? And so it does create that risk of sort of a game of chicken with inflation rates and the Federal Reserve. Is there this possibility that one of them blinks first, where it's Jerome Powell saying, you know what, I was wrong, it's not transitory? And that's an example where you'd start seeing interest rates start going higher. It does increase. So like the second key aspect of this is it does increase the odds that interest rates do actually rise in the future. It is very possible that interest rates just haven't yet caught up with the inflation that Warren Buffett is talking about, and that perhaps even Federal Reserve action in the months ahead. If that happens, if there's a period where rates start picking up in a meaningful way, then I do suspect stocks and the stock market, US stocks, can have a dramatic valuation reset. Because if you're priced, let's say, at 2 to 3% currently on the interest rate, risk reward, and you're saying, here, we're going to use a 2% bond to price stocks, and then it goes to 4% or 5%, that will result in a dramatic revaluation of stocks. Okay, so what can you do about this? And my approach is a couple of different steps that you can take. One is be very sensitive to what you pay for your investments. I would think about a risk reward scenario, and this is what I often do with almost all the stocks I look at. Is I think about low, base, and high scenarios. And I'm thinking, if let's say the 10-year interest rate is at 5% in the future, how much would you be willing to pay for that same stock in that scenario? What's the new valuation? If you were previously at 20 times, are you now at 15? Are you now at 12? And you need to think about that as the low scenario. Or maybe start saying, what if you're revaluing things at 7%? So that's why it's good to have a minimum sort of investment hurdle that you're thinking about as you're considering looking at stocks. So I would say make sure you're underwriting your investments correctly, thinking about what's that opportunity cost risk if interest rates starting to pick up. Second is look for companies with pricing power. That means, once again, going back to that unrivaled company, or if you have pricing power, yeah, there's inflation, you know what, you're going to pass it on to your customers next year. Or or you have a company with a foreign currency exposure. So a perfect example, I recently did a video on Alibaba, and full disclosure, I own some stock on Alibaba. I own some Alibaba stock. And as I call out in the Alibaba video, I think it has a relatively attractive risk reward. And look, most of their operations are in the Chinese renminbi. So, whatever's going on with the US dollar, it's less significant in terms of inflation than what you have going on there. So you're already diversifying away your US dollar risk. Or you can find companies like Google, which is another company, or Alphabet, another stock that I personally own, where they have huge international exposure. So once again, if there's high inflation in the US, and let's say something starts going on with the US dollar, you do have other foreign currency exposure. So first two steps is make sure you correctly underwrite your investments. Think about what your risk reward is based on potentially higher interest rates. Second, think about pricing power. What type of companies you're getting? Are they unrivaled? And then next is, what's your foreign currency exposure? Then the third key approach that I'd consider is that each month, if you're able to try to add more to your portfolio in potential multi-baggers, the types of companies that could potentially go up hundreds or thousands of percent over time. Like if you're able to get enough of these types of companies in your portfolio, that can really change the risk reward in your portfolio. You get, one grand slam that goes up 500 or 1,000%, that changes the weightings of your portfolio pretty significantly. And that's part of the reason why each month, for part of what I offer with Unrivaled Investing Journey, that each month I call out a idea that I think is a potential multi-bagger, I think is a potential unrivaled company, or it has a very strong value proposition and has the potential to, to have a meteoric rise. And then, if you're interested in seeing exactly what I am doing, you can go to unrivaledinvesting.com, click on Journey, and I do, in the first week of the month, I give a full update of my portfolio. You can see everything by percentages, and any material changes during the month, I also let Unrivaled Investing Journey subscribers know. So I hope this video talking about Warren Buffett, inflation, the substantial inflation that he's seeing, what it potentially means for your stocks, for you to think about in terms of the risk reward, definitely does create additional downside risk that one should think about. That increases the risk of sort of derailing stocks, potentially a dramatic stock market revaluation if you get higher rates. So if you enjoyed this video, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.